Most people believe financial crises arrive suddenly. One day everything feels normal.
The next day, headlines scream collapse.
Markets fall. Jobs disappear. Confidence evaporates. It feels like something broke overnight. That belief is wrong. Financial stress almost never appears suddenly. It accumulates quietly inside systems long before anyone notices.
By the time prices spike, or markets freeze, or people panic, the damage has already been done. What people experience as a shock is usually the final stage of a much longer process.
A process that unfolds slowly. Silently. Out of sight.
This is why crises feel surprising, even though they are structurally predictable.
Not because anyone failed to warn people, but because the system hides stress until it can no longer contain it.
This video explains how financial stress builds invisibly, why nothing feels wrong for so long, and why the moment it becomes visible always feels sudden.
Not predictions. Not advice. Just how the system actually works. Financial stress does not start with panic. It starts with incentives.
Every financial system is held together by incentives, interest rates, debt structures, and expectations about the future. When those incentives change, behavior changes long before outcomes do. This is where stress begins.
At first, nothing looks broken. Credit is still available. Markets still function. People still spend. Governments still borrow.
On the surface, the system appears stable.
But underneath, pressure is building. Debt increases slightly faster than income.
Costs rise faster than wages, but slowly enough to ignore. Asset prices inflate, masking underlying weakness.
Institutions take on more risk because they believe they have time. None of this triggers alarms. Because stress, in its early stages, looks like normal growth. In fact, many of the conditions that later produce crises are celebrated at first. Cheap money feels supportive. Rising asset prices feel like prosperity. Expanding credit feels like opportunity. But these conditions do not remove stress. They delay its visibility. Debt absorbs pressure the way insulation absorbs heat.
It keeps the system stable in the short term while increasing fragility underneath.
This is why financial systems can appear calm even as they become more vulnerable.
The stress is real, but it is stored, not released.
And because the system is still functioning, people assume nothing is wrong. This is the most dangerous phase. Because during the invisible buildup, behavior adjusts quietly. Companies rely more on borrowing. Governments depend on refinancing. Households stretch budgets without realizing it. Institutions design strategies around conditions that feel permanent but are not.
The system becomes optimized for stability, not resilience. And the longer this phase lasts, the more fragile the structure becomes. Not because of a single bad decision, but because of thousands of small, rational decisions made under the same assumptions.
This is why financial stress builds quietly. It is not driven by fear.
It is driven by normal behavior inside distorted incentives. And as long as the system continues to function, almost nobody notices the pressure accumulating beneath the surface.
Financial stress does not announce itself.
That is the first reason it is so dangerous. Most people assume that if something were wrong with the economy, they would feel it immediately.
They expect warning signs. They expect discomfort. They expect obvious strain.
But financial systems are not designed to surface stress early.
They are designed to delay it. This is not a flaw. It is the system working as intended.
Modern economies are built to absorb pressure quietly, smoothing disruptions over time so daily life can continue. This buffering effect creates stability in the short term. But it also creates blindness. Because the very mechanisms that protect people from sudden pain also hide accumulating risk. To understand why nothing feels wrong for so long, you have to understand how time works inside financial systems.
Not clock time. Economic time. Economic effects rarely happen when decisions are made. They happen later. Often much later. This delay is not accidental. It is structural. When governments borrow, the impact is deferred.
When central banks change policy, the effects arrive slowly.
When debt expands, the cost is spread across years.
The system is designed to push consequences into the future.
And because those consequences are delayed, people misinterpret stability as safety. In reality, stability often means stress is being stored. One of the most important concepts in understanding financial crises is lag. Lag is the time between cause and effect. In financial systems, lag can last months or years.
Interest rate changes take time to affect borrowing behavior.
Wage pressures take time to show up in prices. Debt problems take time to surface as defaults. During that lag, everything appears normal. People go to work. Businesses operate. Markets open and close. Governments function. There is no obvious signal that pressure is building. This is why financial stress feels invisible. The system absorbs shock instead of reflecting it. Consider how rising costs affect households.
When prices increase slowly, people do not immediately change behavior.
They adjust quietly. They save a little less.
They rely a little more on credit.
They delay certain expenses. None of this feels like crisis. In fact, it often feels manageable. But those small adjustments accumulate. What feels like flexibility becomes dependency. What feels like adaptation becomes fragility.
And because the adjustments happen gradually, people normalize them.
The same dynamic applies to businesses. When conditions tighten, companies rarely collapse immediately. They cut costs. They borrow. They restructure. These actions buy time. But buying time does not remove pressure. It redistributes it. Debt replaces revenue. Efficiency replaces resilience.
Short-term survival replaces long-term stability.
Again, nothing feels wrong. In fact, from the outside, many businesses look healthy. They are still operating. They are still hiring. They are still profitable on paper.
But the margin for error shrinks.
The system becomes sensitive to shocks.
And because this sensitivity builds quietly, it is invisible to most people.
Another reason nothing feels wrong is because financial stress is uneven. It does not hit everyone at once. It starts in specific places.
Often in markets people do not watch closely.
Credit markets tighten before consumer markets. Wholesale funding shows strain before retail banks. Bond yields move before stock prices react. These early signals are technical, abstract, easy to ignore. Most people do not follow them. And even when they do, they are difficult to interpret. Because stress does not move in straight lines. It moves in cycles. Periods of pressure are often followed by periods of relief. This creates the illusion that problems are resolving. In reality, the system is oscillating around a weakening center. Each intervention stabilizes the surface while increasing complexity underneath. This is another reason why nothing feels wrong.
Interventions work temporarily.
Liquidity is injected.
Rules are adjusted.
Deadlines are extended. These actions restore confidence in the short term.
They also deepen dependence on continued support.
The system becomes less tolerant of disruption. More fragile.
But because each intervention prevents immediate pain, people assume the problem has been solved. They confuse postponement with resolution.
This misinterpretation is central to why financial stress surprises people.
The system does not fail when stress appears. It fails when stress can no longer be postponed.
There is also a psychological dimension. Humans are not good at perceiving slow change. We are wired to respond to sudden threats, not gradual deterioration.
When conditions worsen incrementally, the brain adapts. What felt expensive last year becomes normal this year. What felt risky becomes familiar. What felt unsustainable becomes routine.
This adaptation creates a false sense of control. People believe they are managing risk because nothing has broken yet.
In reality, they are simply adjusting to a system that is becoming less stable.
This is why financial stress often feels manageable until it is not. The breaking point is rarely dramatic at first. It is usually triggered by something small. A missed payment. A failed auction. A sudden loss of confidence. These events are not the cause of the crisis. They are the trigger.
The cause lies in the accumulated stress that built quietly over time.
But because people only notice the trigger, they assume the trigger caused the collapse. This misunderstanding leads to confusion. People ask why everything fell apart so quickly. The answer is that it did not.
It fell apart slowly, then all at once.
This pattern repeats throughout financial history.
The specifics change.
The structure does not. Stress builds invisibly.
Buffers absorb pressure.
Behavior adapts quietly.
Then one day, the buffers are exhausted. At that point, the system can no longer hide stress.
It releases it rapidly.
And because the release is fast, people believe the crisis was sudden. In reality, the system spent years preparing for that moment. Another reason nothing feels wrong is because modern economies rely heavily on confidence.
Confidence is not measurable in the same way as physical resources. It is subjective, fragile, reflexive.
As long as people believe the system works, it does. This belief allows debt to roll over.
It allows markets to function. It allows institutions to operate. But confidence is not evenly distributed.
It tends to remain high until it breaks.
There is rarely a gradual decline. Confidence collapses discreetly.
This creates a sharp transition from calm to panic. And because confidence was high right up until the break, people are caught off guard. They assume stability implies strength.
In reality, stability often implies suppression of volatility.
The longer volatility is suppressed, the more violent its eventual release.
This is not unique to finance. It is a property of complex systems. Pressure accumulates when movement is restricted.
When release finally occurs, it is sudden.
Financial systems behave the same way.
Regulations, policies, and interventions reduce short-term volatility. They also reduce the system's ability to adapt organically. Stress accumulates behind the scenes.
Nothing feels wrong because nothing is allowed to move. But immobility is not stability. It is tension. Another factor is narrative.
People rely on stories to interpret economic conditions.
As long as the dominant narrative is positive, stress is dismissed. Rising prices are framed as temporary. Debt growth is framed as manageable. Asset inflation is framed as healthy. Narratives simplify complexity. They provide reassurance. But narratives lag reality.
They persist long after conditions change.
This delay creates a gap between perception and structure. By the time narratives shift, the system is already under strain. People then feel betrayed. They ask why nobody warned them. In reality, the system did not hide stress intentionally. It diffused it. It delayed it. It fragmented it. This diffusion makes stress difficult to detect. It also makes it difficult to attribute.
When everyone is slightly affected, no one feels alarmed.
When pain is uneven, it feels individual rather than systemic.
People blame personal circumstances instead of structural conditions.
This prevents collective awareness. It keeps stress invisible.
Only when stress becomes synchronized does it feel like a crisis.
Synchronization is the moment when individual pressures align. When households cut spending simultaneously. When businesses reduce investment at the same time.
When lenders tighten conditions together.
This alignment transforms background stress into visible disruption. But synchronization happens late. It happens after stress has already accumulated. This is why financial crises feel sudden. Not because they are unpredictable,
but because their early stages are designed to be absorbed quietly.
By the time effects are visible, the underlying causes are no longer adjustable.
The system has already committed to a trajectory. This is why people often feel helpless during crises. The window for adjustment closed long before the crisis became visible.
Understanding this changes how you interpret calm. Calm does not mean absence of stress. It often means stress is being managed internally, hidden, deferred. And when that internal management fails, the transition is rapid. This is not a flaw in individual behavior. It is a feature of complex financial systems. They prioritize continuity over transparency. They protect daily function at the cost of delayed feedback. This design keeps economies running. It also ensures that when breakdowns occur, they feel abrupt.
This is why nothing feels wrong until it is too late.
Not because people are ignorant. Not because warnings were absent.
But because the system is structured to make stress invisible until it can no longer be contained. If financial stress builds slowly, the obvious question is why it is released so suddenly.
Why does a system that absorbed pressure for years appear to fail in days or weeks? The answer lies in how complex systems handle limits. Financial systems are not linear. They do not respond proportionally to stress.
For long periods, additional pressure produces very little visible change. Then, once a threshold is crossed, small disturbances produce large effects. This threshold is what can be called the snap point.
The snap point is not a single event. It is a condition. A condition where the system can no longer redistribute pressure internally. Until that point, stress is managed. After that point, stress is exposed.
What makes the snap point difficult to detect is that it rarely announces itself.
There is no clear signal that the system is approaching its limit.
From the outside, things still appear functional.
Markets still trade. Institutions still operate. Credit still flows.
But the margin for error has disappeared. At the snap point, the system becomes extremely sensitive.
Small disruptions that would normally be absorbed now propagate.
A missed payment matters.
A failed auction matters.
A change in expectations matters.
These events are not causes.
They are catalysts.
They reveal a fragility that already exists.
This is why crises often appear to start with something trivial.
An obscure financial product fails. A regional institution struggles.
A single market freezes briefly. On their own, these events should not matter. But when the system is already under strain, they become decisive. The snap point is reached when buffers are exhausted.
Buffers take many forms. Liquidity is a buffer. Capital reserves are a buffer. Confidence is a buffer. Time itself is a buffer. As long as buffers exist, stress is contained.
When buffers are depleted, containment fails.
One of the most important buffers in modern finance is liquidity. Liquidity is the ability to convert assets into cash without significant loss. In stable conditions, liquidity is abundant. Assets can be sold easily. Credit can be rolled over. Payments clear smoothly. But liquidity is conditional. It depends on trust.
When trust is high, liquidity appears limitless.
When trust weakens, liquidity vanishes quickly. This is another reason why stress is released all at once. Liquidity does not decline gradually. It collapses. Participants who were willing to lend yesterday are unwilling today.
Markets that function smoothly suddenly seize up.
This shift feels dramatic.
But it reflects a binary change in perception, not a gradual change in fundamentals.
Confidence behaves the same way. Confidence is not a steady variable.
It is a threshold variable.
People either believe the system will function, or they do not. As long as belief holds, behavior reinforces stability. Once belief breaks, behavior accelerates instability. This feedback loop is powerful. When confidence is high, risk is ignored. When confidence falls, risk is everywhere. The snap point often occurs when confidence and liquidity weaken simultaneously. This combination is especially destabilizing. Liquidity problems create uncertainty. Uncertainty undermines confidence. Loss of confidence further reduces liquidity. The system enters a reinforcing loop. What was previously manageable becomes unmanageable. This is why stress is released rapidly. The system does not unwind step by step. It reprices expectations. Expectations change faster than structures. Another factor is interconnectedness. Modern financial systems are deeply interconnected. Institutions rely on each other. Markets depend on shared assumptions. Contracts link distant parts of the system. This interconnectedness improves efficiency in stable times. It also accelerates failure when conditions change. Stress rarely remains isolated. It moves through connections. A problem in one area affects another. Losses propagate. Constraints spread. Because these connections are not always visible, the spread feels sudden. But the pathways existed long before the crisis. They were simply dormant. The snap point activates them. Another reason stress is released all at once is because of synchronization. During the build-up phase, stress is uneven. Different actors experience pressure at different times. Households adjust gradually. Businesses adapt quietly. Institutions restructure behind the scenes. These adjustments are not synchronized. As a result, stress remains fragmented. Fragmented stress does not feel systemic. The snap point occurs when fragmentation disappears. When many actors respond simultaneously. This synchronization can be triggered by a shared signal. A sudden change in policy. A visible market disruption. A widely reported failure. Once actors perceive the same risk at the same time, behavior aligns. Alignment amplifies impact. If one business cuts spending, the effect is small. If many businesses cut spending together, the effect is large. If one lender tightens credit, the system adapts. If many lenders tighten credit simultaneously, the system contracts. This alignment transforms stored stress into visible disruption. Another important factor is leverage. Leverage magnifies both stability and instability. When leverage is high, small changes in conditions have large effects. During stable periods, leverage enhances returns. During stress, leverage accelerates losses. Leverage is often invisible. Balance sheets appear healthy as long as asset values remain stable. When asset values change, leverage becomes apparent. Losses compound. This is another reason stress feels sudden. The system moves from apparent stability to rapid deterioration without passing through intermediate states. Because leverage compresses the transition. The snap point is also shaped by rules and constraints. Regulations, accounting standards, and contractual obligations can force behavior changes abruptly. Margin calls require immediate action. Covenants trigger restrictions automatically. Capital requirements impose hard limits. These rules are designed to enforce discipline. They also introduce discontinuities. When thresholds are crossed, behavior changes instantly. This contributes to the suddenness of crises. The system does not gradually adjust. It flips states. From normal operation to constrained operation. Another reason stress is released rapidly is narrative collapse. As long as a dominant narrative holds, contradictory information is dismissed. People explain away warning signs. They rationalize anomalies. They assume stability will continue. When the narrative breaks, reinterpretation is immediate. Past events are reassessed. Risks that were ignored become obvious. Confidence evaporates. This shift in interpretation happens quickly. Because it does not require new information. It requires a new frame.
Once the frame changes, everything looks different. What felt safe feels risky. What felt normal feels fragile. This is why hindsight feels so clear. The information was always there. The interpretation changed. The snap point marks the moment when the old narrative can no longer be maintained. This transition feels like revelation. In reality, it is reclassification. The system did not suddenly become dangerous. It became recognized as dangerous. Another key aspect of the snap point is irreversibility. Before the snap point, adjustments are reversible. Policies can be changed. Liquidity can be added. Confidence can be restored. After the snap point, options narrow. Trust is harder to rebuild than to maintain. Liquidity is harder to restore once it has vanished. Behavior is harder to coordinate once fear dominates. This asymmetry explains why crises escalate faster than recoveries. The system falls faster than it rises. Because rebuilding buffers takes time. Confidence must be earned gradually. Capital must be replenished. Debt must be restructured. These processes are slow. But their collapse is fast. This asymmetry reinforces the perception of suddenness. The snap point is also influenced by expectations about intervention. If participants believe authorities will intervene, they tolerate more stress. They extend credit longer. They maintain exposure. This delays the snap point. It also increases the magnitude of adjustment when it arrives. Because reliance on intervention encourages risk-taking. When intervention reaches its limits, the correction is larger. This dynamic has repeated many times. Stability breeds risk-taking. Risk-taking increases fragility. Fragility leads to abrupt correction. The snap point is the transition between these phases. Importantly, the snap point is not predictable in timing. But it is predictable in structure. Whenever stress is absorbed rather than resolved, the risk of sudden release increases. Whenever buffers are depleted without replenishment, fragility grows. Whenever confidence replaces resilience, the system becomes vulnerable. This does not mean collapse is inevitable. But it does mean that sudden transitions are a normal feature of financial systems. They are not anomalies. They are outcomes of how complex systems manage pressure. Understanding this helps explain why crises feel shocking even to informed observers. The system did not hide stress intentionally. It redistributed it. It postponed it. It concentrated it. When release occurs, it is rapid because the system has no intermediate state. It moves from contained to exposed. From calm to unstable. This is the snap point. The moment when years of quiet accumulation become visible. And because the release is fast, it feels disconnected from the buildup. But the connection is structural. The snap point is not the beginning of the crisis. It is the moment when the crisis becomes impossible to ignore. By the time financial stress becomes visible, most people experience it as a surprise. They ask the same questions every time. How did this happen so fast? Why didn't anyone see it coming? Why does it feel like everything changed overnight? These questions are understandable. But they are based on a misunderstanding of how financial systems reveal information. What people experience during a crisis is not the beginning of the problem. It is the moment when the problem becomes impossible to hide. The shock is not caused by sudden deterioration. It is caused by sudden visibility. Financial systems are structured so that causes and effects are separated by time, distance, and complexity. This separation protects everyday life from constant disruption. It also disconnects people from the processes shaping outcomes. As a result, people encounter consequences without seeing the buildup. They experience the ending, not the story. This creates the illusion of suddenness. One reason crises feel shocking is because the most visible indicators react last. Prices are visible. Jobs are visible. Markets are visible. But these are downstream signals. They reflect decisions made earlier, under different conditions. By the time prices change noticeably, the underlying pressures are already embedded. By the time jobs are affected, businesses have already adjusted internally. By the time markets move sharply, expectations have already shifted. People assume visibility equals causality. In reality, visibility often marks the end of a process, not the start. Another reason the shock feels intense is because financial stress crosses psychological thresholds. For long periods, people tolerate gradual change. They adapt to higher prices. They adjust to slower growth. They normalize increased uncertainty. This adaptation continues until a boundary is crossed. At that point, perception shifts abruptly. What felt manageable suddenly feels overwhelming. This shift is not linear. It is categorical. People move from "this is fine" to "this is not normal" very quickly. This sudden reclassification creates emotional shock. The external conditions may not have changed dramatically in that moment, but the interpretation has. That reinterpretation spreads rapidly. Because perception is contagious. When people observe others changing behavior, they reassess their own. When businesses see demand weaken, they act defensively. When households see uncertainty increase, they reduce spending. When investors see volatility, they pull back. These reactions reinforce each other. What began as perception becomes behavior. Behavior becomes outcome. This amplification makes the transition feel violent. Another reason crises feel shocking is because modern systems are optimized for efficiency. Efficiency reduces redundancy. Redundancy provides resilience. When redundancy is removed, systems operate smoothly under normal conditions. But they have little tolerance for disruption. Small shocks propagate instead of being absorbed. This fragility is invisible during stable periods. In fact, efficiency is celebrated. Systems that run smoothly are assumed to be strong. But smooth operation often means tight coupling. Tightly coupled systems transmit stress quickly. When one component falters, others are affected immediately. This interconnectedness accelerates the transition from contained stress to visible disruption. Because failure does not remain localized. It spreads. Another factor is institutional signaling. People take cues from institutions. Central banks, governments, large corporations. As long as institutions project confidence, people assume conditions are manageable. When institutional language changes, perception shifts. Even subtle changes matter. A different tone. A cautious statement. An unexpected decision. These signals are interpreted as warnings. They often arrive late. Not because institutions are deceptive, but because they operate on incomplete information and political constraints. When institutions finally acknowledge stress, it confirms public fears. This confirmation effect accelerates reaction. People interpret acknowledgement as evidence that the problem is severe. Because if institutions are concerned, it must be serious. This dynamic contributes to the sense of shock. The public does not experience the long internal debates, data analysis, and gradual reassessment inside institutions. They experience the final message, which often arrives suddenly. Another reason crises feel shocking is because media compresses time. Financial news operates in bursts. Attention is concentrated during moments of change. Long periods of gradual deterioration receive little coverage. Sudden movements receive intense coverage. This creates a distorted timeline. People remember the moment headlines changed, not the years preceding it. They associate the crisis with that moment, not with the slow accumulation of stress. Media narratives simplify complex processes. They frame crises as events rather than outcomes. This framing reinforces the perception of suddenness. Even when explanations reference long-term causes, the emotional focus remains on the break. Another important factor is accountability. People seek clear causes and responsible actors. Sudden events are easier to attribute.
Gradual processes are harder to assign blame for. As a result, narratives emphasize triggers rather than structures.
A specific policy decision.
A particular institution. A single failure.
These focal points provide closure. They also obscure the systemic nature of the problem. By focusing on the trigger, people overlook the conditions that made the system vulnerable. This reinforces the idea that the crisis was unexpected. In reality, it was enabled by accumulated fragility. Another reason the shock feels intense is because of loss of reference points. During stable periods, people rely on recent experience to judge risk. They assume the near past is a good guide to the near future.
This assumption works most of the time. Until it doesn't.
When conditions change abruptly, past experience becomes unreliable.
People lose their sense of normal.
They struggle to interpret signals.
This uncertainty magnifies stress. The shock is not just economic. It is cognitive. People feel disoriented. They question assumptions they relied on.
This disorientation adds to the sense of crisis. Another reason the shock feels disproportionate is because of delayed recognition. Often, people realize after the fact that warning signs existed.
They reinterpret past events. They connect dots retroactively.
This hindsight clarity creates frustration.
They ask why they did not act sooner. Why they did not see it. This self-blame reinforces the belief that the crisis was sudden and avoidable. In reality, the warning signs were ambiguous. They competed with signals of stability. They were easy to dismiss.
The system did not provide clear guidance.
This ambiguity is inherent in complex systems. Signals are noisy. Outcomes are uncertain. Action carries cost.
As a result, people tend to wait.
Waiting feels rational.
Until the waiting period ends abruptly. Another important reason crises feel shocking is because recovery takes longer than collapse. The system falls quickly but rises slowly. This asymmetry makes the decline feel more dramatic. People experience loss faster than they experience repair.
This imbalance distorts perception.
They remember the speed of the fall, not the duration of the buildup. They associate crises with sudden pain rather than prolonged vulnerability.
This reinforces the myth of sudden collapse. Another factor is generational memory.
If a crisis has not occurred recently, people assume it is unlikely.
They discount systemic risk. They trust stability.
As time passes without disruption, confidence grows.
This confidence reduces preparedness. When disruption eventually occurs, it feels unprecedented. Even if similar events happened in the past. The absence of recent experience amplifies shock.
Finally, there is the issue of narrative closure. People want crises to have beginnings and endings. They want clear timelines.
They want resolution. Financial stress does not conform to this structure.
It builds gradually, releases suddenly, and resolves unevenly.
This mismatch between expectation and reality creates confusion.
People interpret the sudden release as the start of the problem. They look for solutions appropriate to beginnings.
In reality, the system is already deep into adjustment. This misalignment complicates response.
It also deepens the sense of shock.
Because people feel behind. The most important insight is this.
The shock is not evidence that the crisis was unpredictable. It is evidence that the system concealed stress effectively.
For a time. The same mechanisms that allow economies to function smoothly also delay feedback.
They spread consequences over time.
They obscure causality.
They postpone recognition. This design supports stability in normal conditions.
It also ensures that when stress is finally revealed, it is revealed rapidly.
This is why financial stress feels like it hits all at once.
Not because it arrives suddenly, but because visibility lags accumulation.
Understanding this does not make crises painless, but it does change how they are interpreted.
It reframes shock as revelation,
and reveals that what feels sudden is often the final chapter of a long, quiet process.
Financial stress rarely announces itself. It does not arrive with clear warnings or dramatic signals. It accumulates quietly inside incentives, balance sheets, and expectations.
By the time it becomes visible, the system has already changed. What people experience as a sudden crisis is usually the final stage of a much longer process.
A process shaped by delayed feedback, hidden fragility, and structural limits. Understanding this does not make financial systems predictable,
but it does make them more comprehensible.
This channel exists to explain how money, markets, and economic systems behave under pressure. Not to offer advice.
Not to predict outcomes.
Just to make the structure visible.
If you want clear, calm explanations of how financial systems actually work, you can subscribe to Rich Simplified.
New long-form documentaries are released regularly, each focusing on one system, one mechanism, and one idea at a time. No noise. No speculation. Just explanation.